Are we in a housing bubble? Will the housing market crash in 2022? Will there be another housing crash? Hi, I'm Charlotte, a local realtor here in Thurston County. People are scared right now, and I get it. I went through that craziness 15 years ago. A recent National Association of Realtors survey showed that 77% of consumers believe that we're in a housing bubble. It's completely understandable when appreciation is continuing to be in the double digits. In today's video, I want to discuss 4 key reasons why today is nothing like last time. Number 1, houses are not unaffordable like they were during the housing boom. Affordability has to do with 3 things: home price, home buyer wages, and the current mortgage rate. Conventional lending standards say a purchaser should not spend more than 28% of their gross income on their mortgage payment. 15 years ago, prices were high, wages were low, and mortgage rates were over 6%. Today, prices are still high, wages, however, have increased, and the mortgage rate, even after the recent spike, is still well below 6%. That means the average purchaser today pays less of their monthly income toward their mortgage payment than they did back then. In the latest affordability report by ATTOM Data, Chief Product Officer Todd Teta addresses that exact point. The average wage earner can still afford the typical home across the US, but the financial comfort zone continues shrinking as home prices keep soaring and mortgage rates tick upward. So affordability isn't as strong as it was a year ago, but it's much better than it was during the boom. This chart shows the affordability comparison with the normal lending standard compared with 2007 and today. Number 2, mortgage standards were much more relaxed during the boom. During the housing bubble, it was much easier to get a mortgage than it is today. This chart shows the volume of loans in billions with a credit score below 620. According to credit.org, a credit score between 550 and 619 is considered poor. In defining those with a score below 620, they explain, credit agencies consider consumers with credit delinquencies, account rejections, and little credit history as subprime borrowers due to their high credit risk. Mortgage standards are nothing like they were last time. Purchasers that acquired a mortgage over the last decade are much more qualified. So let's take a look at what that means going forward. Number 3, the foreclosure situation is nothing like it was during the crash. The most obvious difference is the number of homeowners that were facing foreclosure after the housing bubble burst. Federal Reserve issues a report showing the number of consumers with a new foreclosure notice. The numbers are shown in this chart. You can see the 4 years of the housing crash versus the last 4 years. Looking at the pre-pandemic numbers in 2018 and 2019, you can see that they were 279,040 and 277,520 respectively. There's no doubt that in 2020 and 2021, the numbers are impacted by the forbearance program, which was created to help homeowners facing uncertainty during the pandemic. But looking at 2018, 2019, 2020, and 2021, these are fractions of the number it was in 2009 at 2,037,940. However, right now there are fewer than 800,000 homeowners left in that forbearance program today, and most of those will be able to work out a repayment plan with their banks. Rick Sharga, Executive Vice President of Realty Track, explains, the fact that foreclosure starts declined despite hundreds of thousands of borrowers exiting the CARES Act mortgage forbearance program over the last few months is very encouraging. It suggests that the forbearance equals foreclosure narrative was incorrect. Why are there so few foreclosures now? Today, homeowners are equity rich, not tapped out. In the run up to the housing bubble, some homeowners were using their homes like a personal ATM machine. Many immediately withdrew their equity once it built up. When home values began to fall, some homeowners found themselves in a negative equity situation where the amount they owed on their mortgage was greater than the value of their home. Some of those households decided to walk away from their homes, and that led to a rash of distressed property listings, foreclosures, and short sales, which sold at huge discounts, thus lowering the value of other homes in the area. Homeowners, however, have learned their lessons. Prices have risen nicely over the last few years, leading to over 40% of homes in the country having more than 50% equity. I think that's important to repeat. Over 40% of homes in the country have more than 50% equity. Also, note that owners have not been tapping into it like they did last time, and that's evidenced by the fact that the national tappable equity has increased to a record $9.9 trillion. With the average home equity now standing at $300,000, what happened last time won't happen today. If people got into a situation where they couldn't pay their mortgage, most now wouldn't walk away from that equity. They could sell and still have a really nice nest egg left over. As the latest Homeowner Equity Insights report from CoreLogic explains, not only have equity gains helped homeowners more seamlessly transition out of forbearance and avoid a distressed sale, but they've also enabled many to continue building their wealth. There will be nowhere near the same number of foreclosures as we saw during the crash. So what does that mean for the housing market? Number 4. We don't have a surplus of homes on the market, we have a shortage. The supply of inventory needed to sustain a normal real estate market is about 6 months. This means that if nothing else came on the market, it would take about 6 months to run out of inventory. Anything more than that is an overabundance and will cause prices to depreciate, and anything less than that will cause a shortage and will lead to continued price appreciation. This chart shows the supply of homes leading up to the housing crash, showing between 7 and 9 months of inventory, as well as the last 4 years. We've been in a low inventory market in a lot of areas in the country for quite some time, but the last 2 years have definitely impacted supply. The demand is high. The demand is high. Inventory is nothing like last time. Prices are rising because there's a healthy demand for home ownership. At the same time, there's a shortage of homes for sale. That's a lot of data to cover. You know, I love the data. So if you've been worried that we're in a housing bubble and that we're making the same mistakes that led to the housing crash, you can look at the data and see why it's different. For more real estate information, tips, and fun, go follow me on Instagram. You can find the link in the description below. I hope this is helpful. Thank you so much for watching, and I'll see you next time.